Welcome to G Fun Facts Online. Every month, a bill for health insurance arrives. You look at the number, you pay it, and you hope you don't have to use it too much. But have you ever stopped to wonder what that number actually is? Why is it that specific amount? It's not just a price tag pulled out of thin air. It's the result of a massive, unseen calculation, a sophisticated mix of statistics, probability, and financial forecasting. Today, we're pulling back the curtain to decode the mathematics of your health insurance premium. At the heart of all insurance, not just health insurance, are two powerful ideas: risk pooling and the law of large numbers. Let's start with risk pooling. Imagine you live in a small town of 1,000 people. There's a very small chance that any one person might need a sudden, incredibly expensive surgery costing $100,000. For that one person, it's a financial catastrophe. But what if everyone in town agrees to put $100 into a central pot every year? That creates a fund of $100,000. Now, when that one unlucky person needs the surgery, the money is there to cover it. The financial risk of a major health event has been spread across the entire community, making the burden manageable for everyone. That's risk pooling. It's a collective safety net. But how does an insurance company know that $100 per person is the right amount? That's where the law of large numbers comes in. This is a fundamental concept in statistics. It says that as you increase the size of your sample group, the actual results you observe will get closer and closer to the expected average. For an insurer, this is magic. While it's impossible to predict if you, specifically, will need that expensive surgery next year, they can predict with incredible accuracy how many people out of a group of, say, 1 million policyholders will need it. They can forecast the total number of claims they'll receive. The bigger their pool of customers, the more predictable the costs become. The law of large numbers turns individual, terrifying uncertainty into collective, manageable predictability. The people who perform this mathematical magic are called actuaries. Actuaries are the architects of the premium, the financial wizards of the insurance world. They are experts in using math and statistics to calculate the financial impact of risk. They dive into vast oceans of data, historical claims, hospital costs, population health trends, to build incredibly complex cost models. These models predict the likelihood and potential cost of everything from a routine checkup to a major heart transplant. They help the insurance company figure out how much money they'll need to pay out in claims, ensuring the company has enough cash on hand to be there when you need them, without going bankrupt. So when you see your premium, it's not just one number. It's built from several key pieces. The basic formula looks something like this. Your premium equals the expected claims cost, plus administrative expenses, plus a profit margin. Let's break that down. The biggest piece is the expected claims cost. This is sometimes called the pure premium because it's the core of the calculation. It's the amount of money the insurer expects to pay for all the medical services its customers will use over a year. Actuaries figure this out by looking at two things: claim frequency, which is how often people get sick or injured, and claim severity, which is the average cost of treating those sicknesses and injuries. This part of your premium goes directly into the big pool of money used to pay doctors and hospitals. Next, you have administrative expenses. This is also called loading. An insurance company is a business, and it has costs. This part of your premium pays for everything it takes to run that business: the salaries of the employees, including the actuaries, the cost of marketing to find new customers, the rent for their office buildings, the technology needed to process millions of claims, and the customer service representatives who answer your calls. Finally, for-profit insurance companies add a profit margin. Just like any other business, they aim to make a profit for their shareholders. This is a percentage added on top of the claims and administrative costs. After everyone has been paid, the doctors, the hospitals, the employees, this is what's left over for the company. Now, you might be thinking, what's to stop a company from jacking up the administrative costs or the profit margin and charging us a fortune? That's where regulation comes in. In the United States, A major piece of legislation called the Affordable Care Act, or ACA, introduced a powerful rule called the Medical Loss Ratio, or MLR. The MLR is a simple but brilliant idea. It forces insurance companies to be transparent about how they spend your money. The rule says that insurers selling plans to individuals or small businesses must spend at least 80% of the premium dollars they collect on actual medical claims and activities that improve healthcare quality. For large group plans, that number is even higher, at 85%. This is often called the 80/20 rule. It means that no more than 20 cents of every premium dollar can go toward administrative costs and profit. If an insurer fails to meet this target, if they spend too much on overhead and not enough on your care, they are legally required to give you a rebate. The MLR acts as a cap, ensuring that the vast majority of your premium is actually working to pay for healthcare. So we've talked about the whole pool, but how does the insurer set the price for you as an individual? While the overall premium is based on the collective, your specific price is adjusted based on a few key factors. The ACA standardized these factors to make things fairer. The first and most significant is age. Statistically, older individuals use more healthcare services than younger ones, so premiums increase as you get older. However, the ACA puts a limit on this, stating that an insurer can't charge an older adult more than 3 times what they charge a younger person for the same plan. The second factor is your location. Healthcare is a local business. The cost of a doctor's visit or a hospital stay can vary dramatically from one city to another, or even one zip code to another. This is due to local competition between hospitals, the number of specialists in an area, and state-level regulations. So someone in a high-cost urban area like New York City will likely pay a higher premium than someone in a lower-cost rural area. The third factor is tobacco use. Because smoking is linked to so many health problems, insurers are allowed to charge tobacco users up to 50% more for their premiums. It's a direct financial reflection of the increased health risk. Fourth is the plan category you choose. You've probably heard of the metal levels: bronze, silver, gold, and platinum. These categories represent a trade-off. Bronze plans have the lowest monthly premiums, but they also have the highest out-of-pocket costs, like deductibles. You pay less each month, but more when you actually go to the doctor. Platinum plans are the opposite: very high monthly premiums, but very low out-of-pocket costs. Silver and gold fall in between. Your choice directly impacts your premium. The final factor is who the plan covers. A plan for a single individual will, of course, be cheaper than a family plan that covers a spouse and several children. Just as important is what insurers are not allowed to consider anymore. Thanks to the ACA, they cannot look at your health history or charge you more for having a pre-existing condition. Before the ACA, if you had a condition like asthma or diabetes, an insurer could charge you an astronomical premium or deny you coverage altogether. That is now illegal. They also cannot charge different rates based on gender, a practice known as gender rating, which previously resulted in women often paying more than men. Now let's briefly touch on 2 concepts from behavioral economics that add a fascinating layer of complexity to these calculations: adverse selection and moral hazard. Both of these problems arise from something called information asymmetry, which is just a fancy way of saying that you, the buyer, know more about your own health than the insurance company does. Adverse selection happens before you buy a policy. It's the tendency for people who are sicker or who expect to need more healthcare to be more likely to buy insurance than healthy people. Healthy people might think, "I never go to the doctor, why should I pay for insurance?" While sicker people think, "I definitely need this coverage." If an insurance plan attracts a disproportionate number of high-risk individuals, its actual claims costs will be much higher than what the actuary projected for a balanced group. This can trigger something called a death spiral. The insurer has to raise premiums to cover the unexpectedly high costs. But these higher premiums cause more of the healthy people to drop their coverage, because it's now too expensive. This leaves an even sicker, more expensive group of people in the plan, forcing the insurer to raise premiums again. The cycle continues until the plan collapses. The ACA tries to prevent this with rules like the individual mandate, which required most people to have insurance, and risk adjustment programs that transfer funds between insurers to balance out the costs of covering sicker versus healthier populations. The second concept, moral hazard, happens after you've bought insurance. It's the idea that because you're protected from the full cost, you might change your behavior. You might be more likely to go to the doctor for a minor cold or request an expensive MRI because you're only paying a small copay instead of the full price. You might even engage in slightly riskier behaviors because you know you have a financial safety net. To combat moral hazard, insurance plans are designed with cost-sharing features. These are the deductibles, co-payments, and co-insurance you're familiar with. A deductible is the amount you have to pay out of pocket before your insurance kicks in. A co-payment is a fixed fee, like $25, for a specific service, and co-insurance is a percentage of the cost you pay, for example, 20% of a hospital bill, after your deductible is met. By making you share in the cost of your care, these features are designed to encourage you to be a more discerning consumer of healthcare services. The type of plan you choose also has a huge impact on the math. An HMO, or health maintenance organization, usually has lower premiums. That's because they control costs more tightly. They have a limited network of doctors and hospitals you must use, and you typically need a referral from your primary care doctor to see a specialist. This managed care approach allows them to negotiate better rates and makes their costs more predictable, which translates to lower premiums for you. A PPO, or Preferred Provider Organization, offers more freedom. You can see specialists without a referral, and you can go to doctors both in and out of their network, though you'll pay more for out-of-network care. This flexibility makes costs less predictable for the insurer, so PPO premiums are generally higher. And then you have high-deductible health plans, or HDHPs. The math here is very straightforward. You get a much lower monthly premium in exchange for a much higher deductible. You're taking on more of the initial financial risk yourself. These plans are often paired with a health savings account, or HSA, which is a tax-advantaged account you can use to save and pay for medical expenses. There's one more layer to this mathematical onion that most people never see: reinsurance. Just as you buy insurance to protect yourself from a catastrophic health event, insurance companies buy insurance to protect themselves from catastrophic financial events. This is called reinsurance. A reinsurer is an insurance company for insurance companies. They provide a backstop against massive, unexpected losses. Think about a major pandemic or a natural disaster that causes a huge number of very expensive claims all at once. An event like that could bankrupt a normal insurance company. By paying a premium to a reinsurer, the primary insurer transfers some of that catastrophic risk. And, of course, the cost of that reinsurance is another small piece that gets factored into the premium you ultimately pay. Looking ahead, the world of actuarial science is rapidly changing. Thanks to big data, artificial intelligence, and machine learning, these technologies are allowing insurers to analyze data with a speed and granularity that was once unimaginable. In the future, we might see more personalized premiums, where algorithms create highly individualized risk profiles. I could also get much better at detecting and preventing fraudulent claims, which would help lower costs for everyone. Insurers might even use data from wearable devices, like your smartwatch, to identify health risks early and offer proactive, preventative care programs. The goal would be to keep you healthier, which is better for you and less expensive for the system. But this new frontier also brings up serious ethical questions about data privacy, algorithmic bias, and fairness that we as a society will need to navigate carefully. So the next time you look at your health insurance bill, remember it's not just a number. It's the end product of a dynamic mathematical process. It's a blend of statistics and business, of regulation and human behavior. It is the calculated price of turning individual uncertainty into collective security. And in a world of complex and rising healthcare costs, understanding that calculation is more valuable than ever. Thanks for tuning in to G Fun Facts Online.